In 2019, a guy in his mid 30s put $50,000 into a rental property outside of Nashville. Smart move, everyone told him. Tangible, real, something you can actually see. 3 years later, he had a tenant who stopped paying, a roof that needed replacing, and a net return that worked out to roughly $2.40 an hour for his time. Meanwhile, his coworker had put the same $50,000 into a total market index fund and done absolutely nothing else. Same city, same starting point, completely different outcome. Here's what makes that story uncomfortable. It wasn't bad luck that separated them. It was math they didn't run before they decided. Most people pick their investment strategy the way they pick a fantasy football team, based on gut feeling, recent performance, and what sounds good at a dinner party. Real estate feels like wealth. Stocks feel abstract. So the choice often gets made before the numbers ever enter the room. But what if the vehicle matters less than the hidden costs attached to it? That's what this video is about. Because if you're choosing between these two without accounting for vacancy rates, capital expenditures, compounding timelines, and scalability, you're not making a financial decision. You're making a guess with a long time horizon. My name's Alex, and if you've ever stared at two investment options and felt like you were missing something the math wasn't showing you, pay attention here, because the gap between what an investment looks like on paper and what it actually delivers over 20 years is wider than most people expect. I'm going to show you where the real costs hide in real estate, and exactly where the compounding math shifts in favor of stocks. Once you understand how these two paths actually perform across time, you'll stop asking which one is better and start asking which one fits your specific situation. And those are very different questions. It always starts at the same place. Two people, same income, same savings, same city. The only difference is what they do with $50,000 on a single afternoon. And that's where the starting line is. $50,000, same amount, same city, same year. Watch how differently it lands depending on what you do with it next. Daniel is a 34-year-old project manager earning $55,000 a year. He has been saving carefully for 3 years to get to this moment. He puts his $50,000 down on a 3-bedroom rental property, listed at $250,000. The math feels clean right away. His mortgage payment locks in at $1,330 a month. He finds a tenant willing to pay $1,800 a month. That's $470 left over every single month. Daniel runs the numbers on his phone in the driveway, smiles, and drives home feeling like he just figured something out that most people miss. Ryan is a 36-year-old logistics coordinator at the same company. Same salary, same savings. He takes his $50,000 and moves it into a total stock market index fund on a Tuesday morning. Then he sets up an automated contribution of $300 a month and goes back to work. No keys, no tenants, no story to tell anyone. Now here's what's interesting. In terms of visible momentum, Daniel wins the first week completely. He has a physical asset. He has rental income starting next month. When people ask what he's been up to, he tells them he bought a rental property and watches their eyebrows go up. That social signal matters more than people admit. There's something about owning a building that feels like a different category of adult altogether. Ryan just has a confirmation email and a portfolio balance that won't do anything impressive for years. But that psychological gap is exactly where the problem starts. Because the way an investment feels in the first 30 days and the way it actually performs over 20 years are almost never the same conversation. We're wired to trust things we can see and touch. A house feels permanent. A brokerage account feels like numbers on a screen. That instinct made sense for most of human history. It just doesn't map cleanly onto how modern wealth actually compounds. Here's what Daniel's $470 a month doesn't include yet. No property tax, no insurance, no maintenance budget, no vacancy cushion for the month a tenant leaves, and the next one isn't ready. On paper, that monthly surplus looks like pure profit. In practice, it's a gross figure sitting in front of a long list of expenses that haven't arrived yet. Ryan's position looks thin by comparison right now. His $50,000 growing at roughly 10% annually, which is close to the S&P 500's long-run average going back decades, sits at around $55,000 after year one. Add his $300 monthly contributions, and he's at about $58,000. Nothing dramatic. No dinner party story. Just a number getting slightly larger every month without him touching it. The psychological difference between these two men on day one is enormous. The financial difference is actually quite small. And that gap between perception and reality is what makes this comparison worth running all the way to the end. What neither of them knows yet is that the next 3 years will start pulling those two pictures apart in ways that don't show up in any initial projection. Because once Daniel's property meets the actual costs of cash flow reality, the $470 surplus is going to look like a number someone invented on a napkin. Most people calculate their return before the property does anything. Daniel calculated his return on the driveway. That's the first mistake. Year 1 starts well enough. The tenant pays on time. The mortgage is cleared every month. Daniel is collecting $1,800 in rent and sending out $1,330 to the bank. That $470 monthly surplus feels exactly as good as he imagined it would. Then the real world shows up. Property taxes on a $250,000 home in most U.S. markets currently run somewhere between $3,000 and $4,500 a year. Call it $3,200 for Daniel's city. That's $267 a month coming straight off the top before he buys a single light bulb. Homeowner's insurance adds another $140 a month. He's now at $407 in fixed overhead before anything breaks. And things break. 14 months in, the water heater fails. Replacement and installation run $1,100. 2 months later, a section of guttering pulls away from the fascia after a storm. Another $480. His tenant calls on a Friday night about a leak under the kitchen sink. Daniel drives over, fixes it himself, and gets home at 11. The repair cost him $60 in parts and 3 hours of his weekend. Over 3 years, when you add up the property taxes, the insurance, the small repairs, one larger repair, and a single month of vacancy when his first tenant moves out, Daniel's total expenses sit at roughly $14,000 on top of his mortgage payments. His gross rent collected over 36 months is $64,800. His mortgage payments total $47,980. That leaves $16,820 in gross cash flow. Subtract the $14,000 in expenses, and his true net over 3 years lands somewhere between $2,000 and $4,000. That's it. 3 years of ownership, 3 years of phone calls and weekends and tenant screenings, and the actual cash in his pocket is somewhere between $66 and $133 a month. Now, to be fair to Daniel, cash flow is not the whole picture. And this is the part that actually deserves more credit than it usually gets. Because while his monthly surplus was getting quietly dismantled by real-world costs, something else was happening in the background. He bought a $250,000 asset with $50,000 of his own money. The other $200,000 came from the bank. That's 4-to-1 leverage. And in a market where home values have continued to appreciate, it works powerfully in his favor. At a modest 3 to 4% annual appreciation, which is conservative by recent U.S. standards, his property is now worth somewhere around $279,000 to $283,000. His remaining mortgage balance has dropped to roughly $222,000. His equity, the actual wealth he controls, has grown to over $57,000. That's real. That's not nothing. Ryan, meanwhile, has watched his portfolio climb to approximately $76,000 after 3 years of contributions and compounding. He has made 0 phone calls about it, attended 0 weekend emergencies, lost 0 Friday nights. The dollar gap between them is narrow. The life gap is not. And it's about to get more complicated because there's an entire category of costs that haven't hit Daniel yet. The ones that aren't bad luck. The ones that are mathematical guarantees. And every landlord eventually learns to call them capital expenditures. Every landlord eventually learns the difference between a surprise and a schedule. The water heater that failed in year 1 was a surprise. What's coming next is neither surprising nor avoidable. It's just physics applied to building materials, and it runs on a clock whether Daniel pays attention to it or not. This is what capital expenditures actually mean. Not the leaky faucet, not the broken gutter. Those are maintenance. Capital expenditures are the large, structural replacements that every property requires on a predictable timeline. The roof, the furnace, the water heater, the electrical panel, the HVAC system. None of these lasts forever, and none of them sends a warning before they fail. They just stop working, usually at the worst possible time, and the bill lands in full whether the rent check arrived that month or not. Here's the timeline that Daniel should have mapped before he bought the property. Roofs last 20 to 25 years. A standard asphalt shingle replacement on a 3-bedroom home currently runs between $9,000 and $14,000, depending on the market. Furnaces last 15 to 20 years. Replacement cost sits between $4,500 and $8,000 installed. Water heaters last 10 to 12 years, which means Daniel's is already partway through its useful life. Central air conditioning units run 10 to 15 years before they need replacing, typically costing $5,000 to $7,000 for the full system. These are not worst-case scenarios. These are manufacturer averages. If Daniel's property is 10 years old when he buys it, he is not starting fresh. He is inheriting a building that is already partway through every one of those clocks simultaneously. The standard recommendation from real estate investors who actually run the math is to set aside 1 to 2% of the property's value every year, specifically for capital expenditures. On a $250,000 home, that's $2,500 to $5,000 a year sitting in a reserve account. Untouched, waiting. Most first-time landlords don't do this. The monthly surplus feels too small to divert any of it into a fund for problems that haven't happened yet, so they spend it, or they just don't think about it. And then year 5 arrives. For Daniel, year 5 looks like this. The roof, which was already showing wear when he bought the property, finally needs replacing. The job comes in at $8,500. 4 months later, a plumbing issue develops in the wall behind the bathroom. The plumber cuts into the drywall, fixes the pipe, and the bill, including patching and repainting, lands at $1,400. He raises the rent by $120 to offset costs. His property taxes go up by $380 for the year because assessed values in his area have risen with the market. The net effect is roughly zero. When you run the complete numbers across 5 years, factoring in gross rent collected, mortgage payments, routine maintenance, insurance, taxes, vacancy, and now the capital expenditure hits, Daniel's true cash-on-cash return is hovering somewhere between 3 and 5% annually. That is not a catastrophic result. Plenty of people would accept 3 to 5%. But Daniel told people 15 to 20% for 2 years at every social gathering he attended. Those are not the same number, and the distance between them represents a very specific kind of financial miscalculation, measuring the return you projected instead of the return you received. Ryan has not thought about his portfolio in months. It doesn't require him to, and by year 10, that contrast is going to be written clearly in both of their net worth numbers, which, when you finally see them side by side, reveal a year 10 convergence that almost nobody predicts going in. 10 years in, most people assume the gap between these two strategies should be obvious by now. One person owns property. The other owns index funds. Surely the numbers have separated cleanly in one direction or the other. They haven't. And that's the part that makes year 10 worth stopping on. Here is where Daniel actually stands. His property has appreciated at a conservative 3.5% annually over the decade. It's now worth roughly $353,000. His remaining mortgage balance sits at around $178,000. That means his equity, the portion of the asset he actually owns, free and clear, has grown to approximately $175,000. Add in the modest net cash flow he's managed to retain over 10 years after expenses, and his total financial position from this investment lands somewhere between $170,000 and $184,000. That is genuinely meaningful wealth. The leverage worked. Controlling a $250,000 asset with $50,000 of his own money and letting appreciation do its work over a decade produced a real result. Now here is where Ryan stands. His $50,000 initial investment has been compounding at roughly 10% annually, which tracks closely with the S&P 500's historical long-run average. His $300 monthly contributions have continued without interruption. After 10 years, his portfolio sits at approximately $165,000 to $180,000. The compounding is accelerating now in a way it couldn't in the early years. The gains on his gains are generating more new wealth each year than his original contributions ever did. That's the part about compounding that doesn't feel real until you actually watch it happen across a decade. So the scoreboard at year 10 looks like a draw. And in pure dollar terms, it essentially is. But here is what the numbers don't show. And this is the part that deserves to sit with you for a moment. Daniel did not passively arrive at $175,000. He worked for it. He carried a $200,000 mortgage for a decade. He concentrated every dollar of this investment into a single building, in a single zip code, exposed to a single local economy. If that neighborhood declined, if a major employer left the area, if the city rezoned the street, his entire position would have felt it. That's not paranoia. That's what concentration risk actually means in practice. He also spent 10 years absorbing the operational weight of being a landlord. The late calls, the tenant turnovers, the repair decisions, the months when two expenses hit in the same week, and the surplus evaporated entirely. None of that shows up in the equity figure. It was the price he paid to get there, and it was paid in time and stress rather than dollars. Ryan paid none of that toll. 0 debt carried. 0 hours spent managing the investment. His money was spread across thousands of companies across multiple sectors and geographies. When one part of the market struggled, the rest absorbed it. He never lost a night of sleep over a single holding, because no single holding was large enough to matter on its own. Same destination, completely different cost of the journey. What's about to happen in the next 10 years is where the story finally tilts, because the year 20 climax doesn't just show you where both paths end up. It shows you what happens when one of them discovers just how differently these two strategies scale, and that's a year 20 convergence that changes the entire frame of the comparison. 20 years is long enough for compounding to stop being theoretical. By this point, both strategies have had enough time to show their actual character. Not the projected version, not the napkin math, the real one. And what the real numbers show at year 20 is not what either of them expected when they started. Daniel's property has now been appreciating for 2 full decades. At a steady 3.5% annually, it's worth roughly $501,000. His mortgage is nearly paid down. The remaining balance sits at around $89,000. His equity has grown to approximately $412,000. Factor in the cumulative net cash flow he's managed to hold on to across 20 years, net of all the taxes, repairs, vacancies, and capital expenditure hits, and his total return from this investment lands somewhere between $400,000 and $500,000. That is a legitimate outcome. 2 decades of ownership, starting with $50,000, producing 4 to 5 times that in real wealth. The leverage did exactly what leverage is supposed to do over a long enough horizon. Ryan's portfolio tells a similar story in dollar terms. His $50,000, compounding at 10% annually, with $300 contributed every month for 20 years, has grown to approximately $420,000 to $460,000, almost identical to Daniel's position. 2 completely different paths, nearly the same destination. Here is where most people end the comparison. And if you stop here, the conclusion writes itself. It doesn't really matter which one you pick, because over 20 years, they basically converge. That conclusion is not wrong. It's just incomplete. Now watch what happens when Ryan makes one small adjustment. Midway through year 10, Ryan looks at his budget and finds an extra $200 a month he can redirect into his contributions. He's not taking on debt. He's not buying a second account. He's not changing anything structural about his approach. He just updated one number on his automated transfer from $300 a month to $500 a month. That's it. By year 20, that single adjustment pushes his portfolio to approximately $613,000. He added roughly $150,000 in additional wealth by changing a single digit on a screen. Now consider what Daniel would need to do to produce the same jump. He can't simply contribute more to his existing property. Real estate doesn't work that way. To scale his position meaningfully, he needs to save another large down payment, qualify for a second mortgage, find another property in a viable market, screen new tenants, absorb another round of startup costs, and take on an entirely new set of operational responsibilities. He needs to essentially restart the whole process from scratch, doubled. The workload doesn't scale gently. It replicates entirely. That asymmetry is the real insight hiding inside the year 20 numbers. Both strategies can build meaningful wealth over 2 decades, starting from the same place. But one of them scales with a number on a screen. The other scales with the years of your life. This doesn't make real estate the wrong choice, but it does mean that the comparison can't end at the final balance. It has to include what the journey costs, what the scaling requires, and what the risks look like along the way. which is exactly what needs to be examined honestly before anyone picks a side. And that means looking clearly at the real risks and the real trap that sends most people toward the wrong decision for the wrong reasons. Nobody talks honestly about the downside of their own strategy. The real estate investor doesn't mention the eviction that took 4 months and cost him $6,000 in lost rent and legal fees. The index fund investor doesn't mention the March 2020 drop that temporarily erased 34% of his portfolio in a single month. Both of them tell the version of the story where their choice was clearly correct. That's human nature, but it's also exactly how people end up making major financial decisions based on incomplete information. So here is the honest accounting of both sides. Stocks are genuinely difficult to hold through a real crash. The numbers look clean in a chart viewed from a distance. They feel completely different when you're living through them in real time. The S&P 500 dropped 37% in 2008. It dropped 34% in roughly 5 weeks in early 2020. If Ryan had invested his $50,000 in late 2007, he would have watched it fall to around $31,000 within 18 months. Most people say they would have held. The data says otherwise. Net outflows from equity funds spike during every major downturn, which means a significant number of real investors sell near the bottom, lock in their losses, and then miss the recovery entirely. The strategy only works if you actually stay in it. And staying in it when your balance drops by a third requires a specific kind of psychological discipline that is much harder to maintain than it is to describe. Stocks also produce almost no usable income while you're building. A dividend yield of 1.5% to 2% on a $400,000 portfolio generates around $6,000 to $8,000 a year. That does not replace a salary. If Ryan ever needed liquidity during a down market, he would be selling at a loss. The portfolio is growing, but it's largely theoretical wealth until he actually needs to draw on it. Real estate carries its own set of serious risks that the highlight reel version of landlord investing tends to skip past. Vacancy in a soft rental market can run 2 to 3 months, not the single month that most projections assume. A problem tenant who stops paying rent and refuses to leave can stall an eviction for 3 to 6 months in many U.S. states, costing the landlord the full carrying costs of the property throughout that period, with zero income offsetting them. A neighborhood that declines in value over a decade doesn't send a warning. It just erodes the equity slowly until the exit math no longer works. But real estate also has structural advantages that stocks genuinely cannot replicate. In markets with strong rent-to-price ratios, the cash flow after expenses can meaningfully supplement income in a way that dividends simply don't. House hacking, where the owner occupies one unit of a multifamily property and rents the others, can reduce or eliminate the owner's own housing cost entirely. That's a real and powerful outcome. The tax treatment is also legitimately favorable. Depreciation allows landlords to offset rental income on paper, even when the property is appreciating in value. A 1031 exchange allows an investor to sell a property and roll the full proceeds into a larger one without triggering capital gains tax at the point of sale. Used correctly, these tools compound the return in ways that a standard brokerage account cannot match. The real trap in this entire debate is not choosing the wrong vehicle. Both vehicles, run properly with clear eyes and accurate math, can produce meaningful wealth over 20 years. The real trap is choosing based on a social media clip, a confident relative, or the strategy that feels most impressive to describe at a dinner party, without ever sitting down and running the complete numbers for your specific income, your specific market, your specific tolerance for time and stress. That question, did you include everything, is the only one that actually matters. And the answer almost always determines whether the math works for you or quietly against you. Here is what 20 years of honest math actually tells you. 2 people, same income, same city, same $50,000. One bought a building, one bought the market. Both arrived at roughly the same place. The difference was never the destination. It was everything the journey cost to get there. A few things are worth carrying forward. Leverage amplifies both gains and risk. It doesn't eliminate the second one. Compounding rewards patience but punishes panic. Scalability is not a minor detail. It is often the deciding factor. And the return you project before you start is almost never the return you receive once the real world gets involved. Before your next financial decision, ask yourself one question. Did you include everything? Not just the upside, the vacancy, the volatility, the capital expenditures, the hours, the debt load, the exit. There is a deeper question sitting underneath all of this that we haven't fully answered yet. What happens when you combine both strategies deliberately, not choosing between them, but structuring them to work together? That's where the real conversation about long-term wealth starts, and it's worth its own examination. If this changed how you're thinking about the comparison, share it with someone running the same numbers.